Hello, everyone. Thanks for tuning in. I am very excited today because I'm going to have a conversation with an old friend, a colleague, a friend, and actually, I was a client of his over the years. Geoff Dennis, for a lot of you, has been a emerging market strategist on Wall Street for probably longer than he wants to talk about. We first met when I joined Bear Stearns in the mid 90s. And Geoff and I went on a lot of road shows together, and it was very exciting. He's one of the literally one of the hardest working men I've ever met on Wall Street. Geoff has been a strategist for not only Bear Stearns, but some of the big banks out there, UBS, Citibank, Deutsche Bank, HSBC, and has just been a guy that a go-to guy in a sense that people have gone to over the years. So I'm really excited about having Geoff here. I probably talk too much about. He's probably embarrassed by my introduction. So, Geoff, why don't we just jump into it? Because I think, talking about emerging markets, we could have a long discussion, but I think it has to begin with the current environment we have with COVID-19 and how it had affected the world. And really, if you think about it, and you'll go into it, has really had a devastating effect in developing countries. So begin this conversation by giving us your overview of COVID and how you see EM getting through this.
Thanks, Tom, for the intro. Hopefully I can justify your glowing intro anyway. The first thing to comment on is that if you actually look at the numbers, emerging market equities have actually not done that badly compared to the US and compared to developed markets, because year to date, with the usual pattern that you've seen in global markets, which of course a big sell-off in February and early March, and then a big recovery after that. EM is down slightly on the year. Developed markets are up slightly on the year. So it actually doesn't look too bad, although clearly emerging markets are not outperforming. Now, before we get into the issues about COVID-19 and the market specifically, this has got a lot to do with the performance of China, which of course has been so strong this year. And some of the riskier emerging markets have done much worse, such as a Brazil or a Turkey or a South Africa, for example. So we've seen a tremendous dispersion of performance. And really, you've probably got to look at some of those smaller, riskier markets to see the reflection that I think a lot of people thought would be the case from the impact of COVID-19 on the emerging markets. China's buoyed up, if you like, the overall performance. Well, if you look at the various effects of COVID-19, obviously a deep recession followed by some sort of a bounce back. EM has got impacted by that, just like other parts of the world. Some of the second quarter GDP numbers are truly horrendous in places like India, Brazil, South Africa, all of which have published numbers recently, which have been very, very poor. And yet, by the same token, while that's been going on, China, where obviously this pandemic began, has started to recover much more quickly. And so that's sort of softened the blow to a certain extent. But point number one, you've seen very similar pattern, if you like, of economic performance, perhaps slightly deeper recessions in some of these countries, even than the US. There's been a lot of debate about whether or how well emerging markets as a whole have sort of dealt with the pandemic itself, let alone the impact on the economy. And for a long time, it looked like some of the emerging markets would actually perform, so to speak, relatively well, with fewer in the way of cases, fewer in the way of deaths. And I think to a certain extent that's true still across, swathes of Africa, for example, even certainly parts of Asia, Korea and Taiwan, for example, both being emerging markets. But what's happening now, as I think your viewers will know, is that certain big emerging markets, Brazil, India, Russia come to mind, are really getting hit very badly by the pandemic. So in that respect, the macro impact has perhaps been pretty similar to the developed world, apart from, of course, China. Second point to make is that Whereas in the developed world, you've seen a lot of money thrown at these markets through fiscal easing and monetary policy easing, cuts in interest rates, and the resumption, of course, of quantitative easing. You've seen a lot of fiscal action in EM as well. You've seen a certain amount of interest rate cutting in EM also, but you just don't have the room generally in these countries that you've seen in the developed world. So the fiscal side is more fragile in a lot of these emerging markets. I'm certainly not in China, where they've pumped a lot of money into the economy. But, you know, again, Brazil comes to mind, or South Africa comes to mind. And also, you know, there's a limit, I think, with the best will in the world, there's a limit how far some of these countries can reduce interest rates. They're not going to go to zero, even though certain countries are seeing record low interest rates at this point. And that plays into one of the other factors, because one of my favorite views, Tom, as you know very well, is emerging markets do well in a lower dollar environment. Well, we have seen a sharp decline in the dollar. I mean, not a massive decline, but a decline of about 8 to 9% at one stage over versus the euro. But you've seen not a lot of benefit from that for EM. You've seen some benefit, but not what you'd normally get. And that is because you've seen this interest rate carry in emerging markets being, excuse me, cut back compared to what you've seen previously. So that's not been quite the benefit that you would have imagined. And then the final point I'd make initially is that the commodity price story, which is typically a benefit for emerging markets, has been very, very patchy. Of course, oil prices crashed with the stronger dollar in March. That was a negative. You've seen some sort of recovery. But aside from the impact of China in pulling up base metal prices, which has obviously been helpful for the commodity complex, you're not seeing a lot of benefit for EM from commodity prices. And therefore, it's a mixed picture here. But perhaps the conclusion's got to be that the emerging markets, if you look at the equity markets themselves, have not been as badly damaged by COVID-19 as perhaps you might have anticipated. And that's certainly the case if you look at the role that China's played here. Obviously, it's a big market, which has actually done relatively well this year.
Yeah, and that's interesting. It delves into my next question. So part of the reason that you could say, as of today, that EM has done fairly well year to date is because the U.S. market, meaning the S&P, has just continued to go up and hit all-time highs, et cetera, et cetera. And as you mentioned, a lot has to do with stimulus. But let's just talk about, you know, in terms of what conditions, if we see a U.S. pullback, which, you know, is inevitable, and, you know, EM will pull back as well. But what conditions can we look for where EM can start to outperform, as it did in certain times that we know? The developed world, obviously the S&P being the big one. So give us an idea of the conditions you see for that outperformance over the next 12 months, if possible.
I think you need three factors, although the second and third factors are linked together. First of all, I think you need a sustainable, solid economic recovery, which means that if you're going to see the US pull back, or you're going to see US underperformance, what that's got to be driven by, therefore, is not the macro picture as such with a decent economic recovery. It's going to have to be driven by valuations, which, as you say, Tom, are clearly quite stretched in the US market. But if you are to get a decent performance by EM, you've got to see the global economy recovering on a sustainable basis. Now, my own view on that front is that you're probably going to get something of a renewed downturn into the fall and into the winter in the Northern Hemisphere. You're starting to see some hint of that in the US, simply because, you know, lockdowns have been restored to a certain extent. So I think from here, I don't think we're going to have anything like the hit to these economies that you had in the late winter, early spring, which frankly were of, you know, record proportions, the speed and scale of the downturn. But I think from here, it's going to be a very erratic economic recovery, and you do need that recovery, I think, on a 12 to 18 month basis for emerging markets to do well. Because What happens then is that investors are thinking, okay, we're coming out of recession, we're coming out of depression, whatever you want to call it, and they'll be willing to take on a bit more risk. Second point you need is back to what I said earlier. You need to see the dollar continuing to fall such that in traditional fashion, investors, in a time of a weak dollar, push their money overseas, look for risk, look for what carriers left, if you like, in the emerging markets out there, in countries like South Africa and countries like Brazil. And I think the dollar being weaker, which I believe will happen because I still think it's very overvalued. And I think ultimately some of the stuff that's going on in the US, which is this huge increase in the fiscal deficit, the huge increase in the debt ratio, which is the CBO, I think it was in the US the other day, was commenting could go to 100% of GDP in 2021. Whoever thought that would happen, is ultimately, I think, going to bring the dollar down. And so I think that's going to be a factor. And at the same time, as the dollar goes down, which takes some pressure off some of these currencies in emerging and possibly allows them to recover a little bit more, they bounced off the bottom anyway, you will logically see some improvement in commodity prices as well to go with the improvement in the global economy. Now, just as a quick aside in all of this, China is going to play a very big role, not simply because of its size in the emerging markets index, which obviously we'll discuss later, but merely because it's going to be a driver of the global economy. And frankly, the outlook for the Chinese economy on a 6 and 12-month view looks better than the outlook for the US economy and the European economies. And if that were to happen, that will also, I think, pull up the emerging markets. I will also pull up commodity prices in a given weak dollar environment, which I think you're going to see. So I think it's those factors. I think you could throw in an optimistic factor that would help a lot. It's just kind of seems rather ambitious to say this right now, but were you to get some return to sort of structural reform efforts in some of these economies, and you know what I'm thinking of here, the Brazilian situation on tax reform and on government spending reform, for example. There's a massive need for reform still in India, in South Africa, etc. Way to get that thrown in, that would spice up the recovery as well. But frankly, the most important factors are sustained global recovery with the US market reacting to valuations, a weaker dollar, and some sort of move up in commodities, and all of which I think would be underpinned by a better China as well.
Yeah, let's focus a little bit on China. I agree with you that certainly China is going to grow faster than the US or Europe, but that's not saying much given that we're looking at pretty anemic growth. But on the other side of the coin, China is look, and this is more technical speaking, but China is a massive part of the EM index when it wasn't 3 years ago, 5 years ago, and it was non-existent. When you and I worked together 25, 30 years ago, non-existent. Yeah. So how do you think, and this is a recent phenomenon, how do you think this weighting over the last couple of years, and it has been only a few years, has affected emerging market investors? Let's say, your clients, the PMs who you spoke to on a daily basis. How do you, when you speak to them over the years, how do you think it has affected the way they look at emerging markets on a technical basis?
I think with the caveat straight away at the beginning that we're talking here about investors who are obviously following the benchmark as opposed to, hedge funds which are looking for total return or whatever. But to the extent that investors are following the benchmark, I think it's completely altered the whole way in which they do their business. China at the end of, where are we now? The end of August had gone to a record weight of over 40%, sorry, of over 42%. You throw in Korea and you throw in Taiwan, which frankly are really developed economies and probably shouldn't be in the index. You're talking about Asia, China plus quote unquote developed Asia, although the reason it's not developed according to the index, accounting for over 2/3 of the index. Now, immediately what that means to get this point over first, which I think is important, is that the ability of the higher beta markets to drive returns, to drive excess returns, has sort of, it hasn't gone away, but it's much less than it used to be. So, you know, with a lower weight for Brazil, which is about 5% of the index now, a lower weight for South Africa, a lower weight for Russia, a lower weight for, almost minuscule weight for Turkey. What you're going to see here is if investors are taking bets on higher beta markets, and God bless them if they do, because that is traditionally a good way to outperform under the right conditions. You're just not going to get the outperformance you would have got in the past. And so I think if you back that point up, what that really means is that this is now turning into a lower beta index than it was previously, because China's a lower beta market. Korea and Taiwan, certainly, especially Taiwan, to a certain extent Korea, although there's quite a bit of tech in Korea and also industrials in Korea. So I think it's changing the makeup of the index, and by doing that, it's changing the way in which it's going to perform on a relative basis. That's point number one. Point number two is China itself. Do you want, as a fund manager, to have 42% of your money in China? Now, the views of fund managers run the whole gamut here, between people who say, yeah, absolutely, that's fine, no problem, to those who say, I still don't really trust some of the accounting. I still don't really trust some of the companies. You know, you've got former SOE, state-owned enterprises, I should say, or partial state-owned enterprises that are listed. You know, do you feel comfortable you're going to get the returns there, etc. Now, and of course, this is even more the case in the last 3 to 4 years, when the A-share market A-shares have started to enter the index. And of course, the problem here, if you're reluctant to have a big weight in China, is that this weight is just going to get bigger, because as this partial inclusion factor, to use the technical term, on the A-shares increases over time, unless China has a disastrous relative performance, China's just going to get bigger and bigger and bigger, and it's going to move towards 50%. My view has always been that the weight of China in this EM index is not a problem for MSCI. How can it be when the US is 60% plus of the developed market index? What I've always said is that what you need for MSCI to be comfortable is to have this move in the weight being gradual, and therefore not being too disruptive. So if we're nervous about the role of China now, and seeing the index being less high beta than it was, it's only going to get worse. Which leads me to the logical conclusion that at some point you'll see a number of investors, I think, focusing on an EM ex China index. Now, that's hard, because, you know, you're sort of saying, I'm going to be an emerging market investor, but I'm not going to invest in China, or at least China's not going to be part of the benchmark. Now, of course, the kind of the parallel to that in developed markets is an EFA investor, and there's plenty of those. So I think you're going to see some sort of a move towards EMX China. Maybe a fund is going to, you know, split its money up between a China fund and an EMX China fund. So it's going to, you know, it's going to lead to a whole change in the mix of these funds and how they perform. But I think the most important point of all is that the beta of an emerging market fund, an emerging market index today, is going to go down, even if you're jamming a lot of money into Brazil and Turkey and South Africa to pick up a short-term move higher in these high-risk markets. So it's made it a very, very different exercise from, as you said, Tom, when you and I were working together at Bear 25 years ago, when China was a nice big round zero as far as EM was concerned.
Yeah, very interesting point about the beta and the volatility in emerging market index, EEM, et cetera, but interesting. So let's talk about something, I want to switching gears a little bit to something that's related to China, which is commodities, something you touched on a little bit. Let's go into a little bit deeper about, and obviously we've seen a divergence with commodities, so it's not all commodities that have been rising with this boat, but give me your outlook for some of these key commodities, and especially the ones that might affect emerging markets and in turn emerging market equities.
Like a good strategist, I'm going to say short-term down and long-term up, I think. And I'm not trying to be smart by saying that. First of all, I think we've got to get through a lot of softer economic data, and I suspect also some, negative sentiment in markets in the short term still, because of the way this COVID-19 is playing out, which is clearly still going to be with us for months to come. And I think you're starting to see that now in the oil market, where oil is obviously come off sharply in recent days. Now, of course, there's all the usual politics of OPEC involved in the oil market, and great concern that certain of the members are, quote unquote, cheating on their lower quotas on the back of the OPEC deal that was signed a few months ago, and Saudi being, not wanting to really acquiesce in such such damage to this deal. They just don't want to see this deal as the biggest player in OPEC. They don't want to see this deal fall apart. But you clearly have got concerns here about demand short term. I mean, it's astonishing to think of it, but essentially 2020 is going to see about a 9.5 to 10 million barrels per day drop in demand, which, with a bit of rounding, is 10% of global demand. And if you're going to reduce supply by that amount, you've got to do it across the board. You've got to do it consistently. Otherwise, prices will crater again. And that is, of course, has gone with the oil price decline, with a bit of a rally, rebound in the dollar, 120 euro against the euro to 118. Not a big rebound, but it's played a role here. So I think oil is going to stay under pressure probably. I mean, I'm sure it's not going to do what it did in the height of the COVID-19 pandemic impact on these markets. But I think oil is going to stay a little bit under pressure in the short term, which is going to impact Russia and to a certain extent the Middle Eastern markets. But longer term, given the view that I have, the global economy eventually comes back. I think, as you say, longer term it looks better. Now, if you look at some of the metals, though, I think you ought to be getting a relatively smoother ride. And that's simply, of course, because the Chinese economy is clearly recovering pretty strongly now. Not only is it recovering pretty well now, but clearly you're seeing China, from some of the export data that's coming out, you're seeing them gain market share in terms of global exports. And that would indicate that the economy is really recovering pretty well. And that you put that down to partially monetary easing, but also tremendous fiscal expansion, as is typical in China, which means at some point we might have to go back to worries about Chinese debt. But I think that's not a short-term issue here. And so I think to the extent that China is building stuff again, easing fiscal policy, you will see things like iron ore and copper, I think, be on a better trajectory short-term, assuming, of course, the dollar does not rise sharply from here, which is certainly not my view. I think dollar basically goes down again at some stage. Now, the other point I'll make, which I think is very positive for commodities, is I think I'm in the camp, Tom, that suggests that there is an inflation risk down the road because of all the money that's been pumped into the economy. I think it's interesting how, sorry to talk about the US here, but how the CPI numbers in the US have been moving up pretty remorselessly over the last, maybe that's too strong a word, but they've been moving up decently over the last 2 to 3 months. Year on year CPI inflation is around 1.5% now, which of course is very low, but it's clearly moving up. The latest driver of that, bizarrely, is used cars, but there you go. And as inflation starts to move up around the world, not only is that going to create a dilemma for when some of these central banks start to pull some of this massive support in QE in particular out of the markets, that's a whole separate issue. But I think it is going to mean that commodities stay well bid. I think it's going to push downward pressure on the dollar. And I think although gold's come off the top recently, just below $2,000 to the ounce, it's going to push the gold price up as well. So I think some of these commodities look a little vulnerable short term, especially oil. But I think on a 12 to 18 month view, which will be very helpful for EM, I would think logically commodities do quite well with the global economy, with inflation. And that certainly is going to be a positive at the margin for EM.
Yeah. So let's drill down a little bit. So let's go through each of the EM regions, Asia, LATAM, and EMEA. And as you go through the regions, maybe you can sort of mention your favorite markets over the next 12 months in each region. So let's start with Asia, then we'll do Latin America and EMEA.
all three look pretty different to me, and to the extent there's any similarities, it's probably between Latin America and emerging Europe, Middle East and Africa. Anyway, as far as Asia's concerned, which has been a massive outperformer this year, it's going to be driven by China, and it's going to also be driven by, which is sort of the same point to a certain extent, by the very, very successful, relatively successful management by most of these economies of COVID-19. Now, I know there's pockets, we have pockets in China, we've had hotspots in Korea, etc. But basically, I think the big positive for Asia out there is the recovery that's going on now with respect to China, the relatively good performance, so to speak, on the pandemic in places like Korea and Taiwan. And what that will allow to happen is for these economies to recover a little bit more quickly. Now, clearly, with respect to Korea and Taiwan, and to a certain extent China, you've got concerns there. You've got concerns to do with the tech sector, which is well represented in all of these three markets. Given if you're really worried about any of the indices in the US being overpriced, it's probably the Nasdaq. Although I'm of the view this is a totally different environment from 2000, from the tech bubble then. And obviously, there's also the residual concern about US-China relations and the trade war that's gone a little bit on the back burner now, and to what extent that gets revived will be to a certain extent driven by, obviously, the result of the US elections in about, just under a couple of months' time. But generally, I think the outlook for Asia looks pretty good. It is already an outperformer. And that may make investors a little bit wary, but I think these factors will benefit the region. Obviously, it's not as big a beneficiary by any means from higher commodity prices. Indeed, some countries like Korea and Taiwan and India, of course, are big importers of commodities. Were there to be a big commodity surge, that would be a negative there. I think you'll see some decent performance by the ASEAN markets. I think it'll be patchy. I'm less keen on Thailand, the Philippines. Indonesia gets some benefit from higher commodity prices. Malaysia's dealing with a lot of political instability. And then you need to look at India, which unfortunately is right in the forefront of the COVID-19 pandemic worldwide, with very, very little fiscal room, very little additional monetary policy room, and frankly, a government that has come under huge criticism, externally if not internally, from a botched lockdown, which simply made COVID-19 worse. And the collapse of the economy, maybe that's too dramatic, the sharp decline in the economy in Q2, the first fiscal quarter of the new fiscal year for India, is really showing how badly the economy is being hit. And there's a lot of desperately negative talk in India about, the end of the miracle, growth has gone away. This government hasn't done very well after all with the demonetization 4 years ago, the slowness of the reform. And suddenly, unemployment's at very high levels. The growth has basically disappeared, which is shocking for a country that's still got a very, very low GDP per head. So I think although India traditionally is viewed as a sort of defensive market, I think you have to view it here as a market that's probably going to underperform because it's always somewhat expensive. If you look at Latin America, it's very clear what we need to see in Latin America is we need to see some rebound in these economies, perhaps driven by a global rebound. You need to see, above all, in a country like Brazil, some of the other commodity plays as well, a lower dollar to help to support commodity prices. But what you also need to see is you need to see a stabilization of the coronavirus in these economies. I think particularly Brazil, to a certain extent Mexico, where it's also very serious, and also countries like Peru, where it's been unusually bad relative to certain other of the smaller economies. And if you look at Brazil, which is about 55-60% of Latin America still, you need to see an end to the concern about, which is easy to say, by the way, end to the concern about the reform program, given that Bolsonaro is already starting to look ahead to re-election prospects down the road. You've got midterm elections in the fall here. And of course, there's a tremendous risk, I think, in Brazil that they will simply move away from the cap on government spending, the control of fiscal policy, and will really stop the reform program going any further short term, which will lead to a big problem for the markets if it leads to the resignation of Finance Minister Guedes, which is obviously a distinct possibility. So I think you have to throw risk of reform and risk of reform slowing and risk of politics in Brazil into the mix. If you look at the other big market in Mexico, frankly, you've got a bizarre approach to the pandemic and a bizarre approach to policy from AMLO in Mexico, not wishing to spend any money at all, really trying to deny, although he's one of the deniers, of course, of COVID-19 to a certain extent, and a dramatic loss of confidence in what's going on in Mexico, and a very, very weak economy indeed. And so if I were looking at the markets to favor here, I would far rather take a bet on Brazil at this point, getting through this, notwithstanding some very challenging fiscal measures and obviously a very low carry now with interest rates at record lows, than I would in Mexico, where policy, frankly, is just all wrong, with no fiscal expansion at all. And yet, despite that, the deficit's going up, and there's a lot of concern that Mexico could lose its investment grade rating, which it's had now for not far short of 20 years, not quite 20 years. So in Latin America, I'm looking for a lower dollar, a rise in commodity prices, some stabilization of the economy ultimately, and reform efforts trying to get back on track. And I'd probably look at Peru as the other obvious market to go for, because that's suffered badly. The economy maybe gets better from here, and obviously a big beneficiary from higher metals prices. In EMEA, just a bit more quickly, it's a mishmash of countries, and so it's all very, very difficult. What I'd say to you is Russia short term looks difficult because of oil, but longer term, I think, will look pretty good. We need to know what's going to happen in these elections coming up in Russia in the fall, because obviously Putin's approval rating is through the floor now, and how well, if at all, he comes out of that will be important. But here's, as usual, a cheap market, very much driven by commodities, in particular oil. So I think Russia does well in a 12 to 18 month view, but maybe not so well in the short term. Turkey, I would avoid completely, because it's one of the countries where you've seen no recovery of the currency at all. And I don't think you would expect that with policy being completely inappropriate, interest rates way too low, real rates negative, the fiscal side is under pressure. And so to the extent that we may be wrong on the currency and the dollar doesn't go down, you'll see Turkey probably blow up and have a major crisis here. And even if the dollar does go down, it's hard to see Turkey being much of a beneficiary of that, because policy is wrong. And then I think South Africa is also challenged, but for different reasons. Currency has rallied there, but the danger, the challenge in South Africa remains exactly the same. The extraordinary level of unemployment, the dominant size of the black underclass, which is just doing so poorly, and the lack of reform, even with the change of government away from the highly corrupt Zuma government towards a more, perhaps I should say, clearly a cleaner government, if I can use that, of Ramaphosa. But the economic challenges are very severe. I think the countries that do decently in EMEA would be Central Europe if Europe starts to recover, but you have smaller markets there, but still they should do relatively well. I think Russia in the medium term. And I think as oil prices eventually do start to rally on a 6 to 12, 12 and 18 month view, I think there'll be increased focus on the Middle East, where of course Saudi has become a decent sized market. And so a little bit with oil is a short term, long term thing, but that's generally how I would position myself. So, rather boringly perhaps, I would continue to go for the lower beta markets, the ones that have been winners this year, as being the leaders in the near term in particular, and those are the big markets in Asia.
Without going into too much detail, because these markets aren't, but do you have any view on frontier market as a whole, not in individual countries, but sort of the frontier theme as part of an EM theme? Given your outlook, is there any reason to look to maybe allocate money to Frontier? Again, you don't have to go into specific countries, but
I think the argument there would be that if EM is under pressure, which I think it's fair to say, notwithstanding the weird makeup of the index, it really hasn't been under a lot of pressure. It's rebounded quite nicely. It's, you know, when we look at the numbers 5 years down the road, you look at 2020, you're going to say, hey, this was not an awful year, unlike 2008, which was a truly awful year for emerging markets. So, but to the extent that EM is under pressure, I think the appetite for investors to go, if I can use this expression, yet further down the food chain into Frontier, I think will just not be there. That's point number one. Having said that, in a world now of EM, which is dominated by especially China, and is dominated by China plus Korea, Taiwan, as I say, about 2/3 of the index, you may well, under more positive conditions, which, as I say, I think you'll get eventually with the economic recovery being more stable, or perhaps I should say more predictable as you go into 2021 with a lower dollar. I think investors might decide that, look, you know, I'm really going to see if I can outperform here, outperform some sort of an index. It may be harder to outperform in an EM index that is lower beta, and it might be easier to outperform by sprinkling my portfolio with a bit of frontier markets. That would be another point I would make. I think the other thing I would say is that what's interesting about frontier markets is it's massively dominated by countries in sort of east of Europe and west of Asia, whether you're talking about the former Soviet Union, obviously the CIS states, we can still call them, parts of Eastern Europe, small markets, Croatia, Slovenia, Slovakia, those sort of markets. You know, you look at Kazakhstan, for example, about which I know nothing, except I know that Kazakhstan exports oil. So to the extent that some of these countries are oil exporters, I think that would appeal to investors. And some of these other countries are you know, effectively pretty closely tied to Europe, which I think will help, you know, the emerging European countries, you know, CE3, and therefore may have a spillover effect in some of these other countries, which are part of the frontier market index, but by the same token are also members of the euro, or if not members of the euro, are tied to the euro in anticipation of ultimately becoming a part of the common currency. So that might help those markets, especially in a weaker dollar environment. Then finally, I'd say the following, is that if there is a long-term fallout from the trade war with China, it is going to be the repositioning of supply chains at the margin outside China into some of the yet lower cost countries in Asia. And what springs to mind are countries like Vietnam and Bangladesh and Sri Lanka, all of which are part of the frontier market index. Now, obviously, there's not a lot of Asia in the frontier market. It very much is emerging Europe, Middle East, and Africa. But to the extent there are Asian countries in the frontier index, they could get some structural benefit long-term from the trade war with China, which, and I think we all know that in the event that the Democrats win the White House and Vice President Biden becomes president, we're not just going to go back into a fully old-fashioned, you know, very cooperative style of relationship with China. There's still going to be a lot of pressure put on China. So I think those supply chain implications may still be there. So I think there is some work that can be done in frontier markets. But the most important point is going to be, if you want beta, it's less easy to get that these days in EM, and maybe people under the right conditions would look to get that in frontier markets.
Good point, Geoff. Well, I want to thank you very much. This has been this is wonderful to catch up. I hope I can make it out to the West Coast and we can grab a coffee or play golf at one point. But thanks again, Geoff. It was very informative, and we definitely appreciate your insights.
Thank you, Tom, very much. Great fun. Thank you.